All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. A few more fireworks in the market here this morning as the ISM services number created a 35-point drop in a matter of a couple minutes. Since then, we've seen the market rebound most of that 35-point drop, but that's a pretty steep drop here. We'll go out and take a closer look at the ISM number here in just a moment. For the challenge, we're in all cash. There are no new signals on the board right now. If we go and we take a look at the crossovers, there are some upside and some downside crossovers. GLD and Pepsi both have upside crossovers. If you recall, Pepsi had a downside crossover yesterday, and today after its earnings has an upside crossover. Nowhere close to setting a signal. Same with GLD. And this is the gold ETF, and for as much as I'd like to trade the gold ETF higher, the consolidation risk here on this crossover is similar to what we saw right back here at the middle of September. And yeah, we had 2 days of follow through, but not enough to get it to average true ranges or to really make the trade work in a big way. And so GLD not triggering here on the bullish side this morning. But those are the upside 3-7 crossovers. On the downside, we have a couple. We have Apple and Whirlpool. Now, neither of these stocks are anywhere close to signaling. They're both coming off, brand new highs, essentially, and we're just not going to get bearish signals off new highs. The algorithm's built to basically say, look, if new highs are set, no, we're not. It's not going to be a signal. And same with Whirlpool. So coming off a new high here as well, and also kind of just has that very similar element that Apple has here on it. So nothing to get into right here. There's some interesting stocks out there in the market. You take a look at some of the pullback we've seen in some of these names like a Visa and a Home Depot, and you look at a pullback in an IBM, and yeah, there's some temptation there, right? But we're talking about fresh downside 3-7 crossovers. We're talking about breaking of the 20-day moving averages. We're talking about some more material technical damage having been done here so far this week to many of the stocks that are out there. So nothing to go get into here this morning. Now, going back to the big dip that we had here just about 30 minutes ago, it was catalyzed by the ISM number, ISM non-manufacturing, or the ISM services number. And we saw the ISM manufacturing number on Tuesday. That drove the markets down. We saw that reversal Tuesday, Wednesday, and then the ISM services number comes in, and it's above 50. So it's showing expansion, but it's its lowest number since 2016, and the trajectory of the number continues to get worse, right? It just continues to get worse month after month. We saw a nice bounce last month that gave investors some hope, but we saw a dip again here this month. And if we go look at just the number itself, there's some alarming elements in the number. You can just see how big the erosion is, from 56.4 down to 52.6. That's a big erosion, and a lot of that, look at the new orders. One of the big bright spots last month, and I think it's one of the big reasons why we saw September generally trade higher in the markets, were the new orders were really strong. We saw a nice uptick in the new orders, and that has come crashing on down along with the employment. So production, new orders, and employment crashing on down here. Very ugly number in that regard. And, some of the other things like prices, backlogs, new export orders, those are what are keeping the number from being negative even more. So it's just one that, there's not a lot of silver lining here with the number, and we continue to see the data erode here if we look at, a grander scheme of things. So that's the ISM number. Now, we also heard from the Fed this morning, and basically talking about, hey, we're not going to let the political forces determine what we're going to do and everything else, and they normally don't. But they do let the market forces determine what they're going to do, and the market forces have made a big change here. And what I'm coming into is the CME Fed Watch tool. And this basically puts out the probabilities for rate cuts, rate hikes that the market is priced in. It uses bonds and bond futures. It uses the actual pricing of them to say, what is the market priced in? This isn't analyst opinion. This isn't even Fed opinion. This is what the market has priced in monetarily here. Now, take a look at a week ago. This is for the 30th of October meeting, so the end of the month Fed meeting. A week ago, the market was pricing in no rate cut by about 50%. 50% chance of no rate cut, 50% chance of a 0.25 rate cut, right? That's what the market was pricing in. 50-50, they may cut, they may not. As of yesterday, it was 23% that they wouldn't cut, 77% that they would cut. That's a big change. As of today, 94% chance of a rate cut, 5% chance that it stays the same. We have the market basically in 2 days going from, hey, a 50-50 proposition that there's a rate cut to almost 100% proposition there's a rate cut. Where the market is absolutely pricing in a rate cut. We have never seen the market price in a rate cut to this degree where the Fed hasn't cut the rate. So it's one where it's pretty clear what the Fed's going to do here in October should this stay the same. Maybe even more meaningful and more impactful is if we go out to December and we look at how this has changed. A week ago, there was a 31% chance that by December the rate would be the same. 50% chance that by December the rate would be down 0.25. So somewhere within the next two meetings, the Fed was going to cut rates. Well, look at how this has changed. It's now 2.5% chance that it stays the same. 47% chance of a 0.25 rate cut. That's lower than what it was a week ago. So the market's actually pricing in a lower chance of 0.25, but what's it doing? It is pricing in a 50% chance that not only does the Fed cut this October, but they also cut in December. And that is a big shift here for the markets. And, we have seen the data drive this bond action, drive this pricing action here in terms of the Fed rate cut. And so it continues to leave, the bulls and the bears in very interesting positions here. Where, the bears, they can look at, eroding earnings. They can look at eroding economic data. They have the trade war, Brexit, a lot of geopolitical macro factors here. It's almost a slam dunk case for the bears. Except for what? Well, the bears, how many times have they woken up to we're going to work something out with China, and absolutely got torn apart. We have the Fed looking to cut rates. Some bears are going to argue that, hey, during a rate cut cycle, markets fall, and there's very good evidence for that. But they're keeping the bear case from being an absolute slam dunk. Where the bulls look and they go, well, you know what? We don't quite have cheap valuations, and we have revenue and earnings starting to erode. Okay, if we have the trade war, resolve itself, then great, we're good to go. We're golden, right? And so there's just a lot of, ifs. There's a lot of kind of back and forth here. Neither bulls nor bears have that slam dunk type of case. And, that's going to continue to lead to, some bigger market moves here. Now, yesterday, I made a comment about market participation and seeing some of the, really big funds dumping some of their stocks and some of the best performers as of, overall this year. And that, hey, we're kind of seeing some of them cash out for the year. And yeah, we're seeing that, but it doesn't mean in any way, shape, or form that the market's going to go flat, stagnate, or anything like that. When we talk about that, we're talking about a very small portion, right? A very small portion. And when we see less market participation, we tend to see two things. We tend to see volumes go up, right? Because the algorithms kick in a lot more. And we tend to see more volatility, bigger moves to both the downside and the upside. You think, yes, it's easy to kind of make a bearish case. Oh, you know what? The big fund managers throwing in the towel for a while, they're going to come back in January. And to say, well, that's super bearish. But if you think about it this way, it's also a very bullish proposition. If we have fund managers throwing in the towel here this week and next week and saying, I'm done for the year, right? Then what's going to happen if there's a trade war resolution? There's going to be a big uptick, right? Those fund managers, most of them will miss out. They don't have to be in. We don't have to have a buyer for every seller or a seller for every buyer. We can see a big shift, a big move in the market while they're left on the sidelines. Now what are they going to be forced to do? They're going to be forced to play catch-up, especially as we get into January. They're going to have to play catch-up, and they're going to have to put in, a little bit more aggressively, than what they would like. So you can make a very bullish case for the fact that, some big fund managers are dumping out here. I didn't bring it up yesterday to be something that you make big decisions based off of, but just to understand kind of some of the concept and elements of what are going on out there, and to kind of make that argument that I made yesterday, that I expect the moves to be bigger going into the end of this year than what we have seen for much of this year. And that's my expectation. And, yep. Does it have to materialize? No, right? There's a lot of news. There's a lot of, a lot of stuff out there in the markets to be resolved. But I do expect that, and, bigger moves to the upside, bigger moves to the downside, and maybe even more so than 3, 4, 5, 6 days in a row in terms of upside moves, or 6 days in a row in terms of downside moves. So not this kind of 1 day up, 1 day down, 2 days up, 2 days down kind of chop that the market has been experiencing here of late. So hopefully that helps kind of clarify that and that understanding there. But anyway, that's where things are here this morning. We'll be back on here with you this afternoon. Have yourselves a fantastic day, and we'll talk to you then. Take care.